In case you have missed it, the Trump administration has almost completely taken over the Federal Reserve and will do so in early 2026. And interest rates are about to go back to zero, just like back in 2020. The thing is that this could be the most explosive setup for stocks and crypto that we've had since that time. And yes, just like I said a day ago, Trump literally told people to go out and buy stocks.
You better go out and buy stock now. Let me tell you, this country will be like a rocket ship that goes straight up. This is going to be numbers that nobody's ever seen before.
Now, when it comes to this interest rate decision that we're about to get here on the 10th of December, a few months ago, Powell basically told us that if you're driving in the fog, you should slow down. Well, the Fed is driving in the fog right now. We do not have all of the data that we would like to have to be able to really know what comes next. So with that said, instead of having data-driven cuts that are happening right now, we're getting vibe cuts, or as Powell politely called them, risk management cuts, and honestly, risk management cuts that are slightly politically driven. Trump wants one thing, and he wants it fast, which is lower interest rates. Now, although Trump has publicly criticized Powell left and right all year, calling him a fool, a numbskull, and a stupid person, Powell is only one of the 12 voting FOMC members. So because of this, the Trump admin have been trying to shuffle players around inside of the Federal Open Market Committee, pushing the legal limits of the system in order to make that happen. Where earlier this year we had the expose of Adriana Kugler and essentially attacking her for some ethical mishaps as a board member, which led to her early resignation, where Trump put Stephen Myron in her place. They also tried to fire Lisa Cook, another Fed board member. And eventually that was blocked because the Supreme Court said, hey, you can't do that, right? You can't just fire a Fed board member. That's not legal. Now, Trump will get the opportunity to land the final blow as Fed Chair Jerome Powell's chair term ends in May 2026, where Trump is then expected to nominate Kevin Hassett, the director of the White House's National Economic Council, for the Fed chair position. In an interview with Fox News last month, Hassett said that he would be cutting rates right now if he were in Powell's shoes. Prediction markets are putting the odds of Hassett being the one who's nominated at around 86%, compared with 6% for Kevin Warsh and 4% for the sitting Fed Governor Michelle Bowman. So, as it is, let's talk about what the Fed has already done regarding interest rates and their monetary policy. So as it is, the Fed already ended quantitative tightening by stopping the roll-off of mortgage-backed securities off of their balance sheet. And going into the December Fed meeting, we have an 85+% chance of a 25 basis point cut to end the year. And after that, we don't really necessarily have a clear path of what's going to happen, but the political pressure is enormous, and it is clear in which direction, right, we would like to see, the Trump administration would like to see rates going lower. So with a target rate of something like 1% or better, and when I say the target rate, I'm saying the rate at which the Trump admin would like to see, we're likely going to be heading into a low or even ZIRP policy rate in the near future. ZIRP meaning zero interest rate policy. Now, the issue that the Fed has here is that the labor market is not looking all that great. That's pushing the Fed towards lowering interest rates to spur investment into the economy. But then on the other hand, we have sticky inflation, with the most recently released data having the CPI at 3%. Now, the data hasn't really been coming out lately, so we really don't have too much to actually base this decision on in the near term. So the issue here is lower rates, increase investment into the economy, and watch the economy do better. But with that, you're going to potentially re-spark inflation, which is already pretty sticky. So the data's messy and the data's unclear, but the politics are very clear. Now, over the weekend, Trump signed an executive order to address the inflation topic after recently calling the affordability crisis in the U.S. a Democrat hoax.
This whole thing is, they use the word affordability. It's a Democrat hoax.
So the executive order is meant to address the fact that certain companies in the American food supply chain have even settled civil suits accusing them of price fixing for tens of millions of dollars. Now, this executive order establishes a food supply chain security task force within the Department of Justice and the FTC, the Federal Trade Commission. Now, this is meant to determine whether anti-competitive behavior exists in food supply chains in the United States, as well as whether the control of food-related industries by foreign entities is increasing the cost of food products in the U.S. or even creating a national or economic security threat to Americans. Now, popular macro analyst and investor Darius Dale had something to say about this. He called out the executive order and tweeted, "The gaslighting of the public about inflation whilst presiding over one of the biggest annual declines in the US dollar index ever, and mafia-style bullying of the Federal Reserve to slash interest rates by hundreds of basis points is all-time levels of out-of-touch billionaire arrogance." Now, the argument here is that instead of focusing on foreign manipulation of food prices, there may be a need to take a look at the administration's policies regarding import and export, right, or the tariff policies. So Darius Dale is pointing out that maybe, right, the inflation has something to do with Dixie being down almost 10% on the year. Now, if you don't know what the DXY, the Dixie index is, it tracks the value of the US dollar against a basket of 6 major foreign currencies, like the euro, the yen, and the pound, the Japanese yen, by the way. And so a higher Dixie means a stronger dollar, a lower one means a weaker dollar. When the dollar index falls, it means it takes more dollars to buy the same amount of foreign currency. This makes imports more expensive for US buyers and suppliers. So the result of that is that higher costs will get passed along the supply chain to wholesalers, retailers, and ultimately consumers. So you have commodities like oil, wheat, or soybeans, and other inputs in the food equation, right, which are globally traded in dollars. When you need more dollars to buy those things, right, the prices of them essentially has gone up. So a weaker dollar will push the prices up and amplify food inflation. And this is what Darius Dale is trying to point out. It's like, is this really a matter of price fixing, or are we dealing with the fact that we have overall economic, high-level economic pushes and forces, right, that are pushing prices up in the economy? Now, another important thing to understand is the concept of interest rate differentials. The idea is that currencies around the world trade at different interest rates. So lower interest rates decrease the demand for the dollar, which would send the Dixie even lower. So if you can use another currency to get a higher return, then you will dump or even borrow the low interest rate currency to go out and buy another higher interest rate currency. This is what's been happening with the yen when they had negative interest rates and the unwinding of that trade as interest rates in Japan have gone higher. So this could further exacerbate the decrease of the Dixie on the global scale if we continue to lower interest rates and we get that zero interest rate policy in place in the US. So the overall idea of inflation being a force of anti-competitive behavior, right, that allows the Trump administration to justify maintaining its tariff policies while also still pursuing that lower interest rate policy. Now, on top of this, right, Trump has also been drumming up support from the populace on maintaining these tariffs by continuing to promote the idea that tariffs may lead to the ability to eliminate income taxes.
Over the next 2, 3, 4 years, those numbers are going to go up. And I believe that at some point in the not too distant future, you won't even have income tax to pay, because the money we're taking in is so great, it's so enormous, that you're not going to have income tax to pay. Whether you get rid of it or just keep it around for fun or have it really low, much lower than it is now.
Which sounds pretty nice, right? With all that said, what do lower interest rates actually mean for investors? The way that I see it, rates will go lower and they will likely go to zero. It might not happen all at once, and in fact, it probably won't. But I think that by the end of next year, I would not be surprised by a 1% or even near zero interest rate policy in the US. Let's not forget that back in 2019, Trump even called for a negative interest rate back in his first term. So lower rates mean one important thing for investors, and it means risk on. Let's keep in mind that the Dixie is down 10% and may go even lower with a lower interest rate. This could be exactly what stock markets and crypto need to go higher over the next year. And even just the anticipation of that idea could be enough to push risk assets up. As mentioned, Trump literally said out loud last week to go out and buy stocks. And because of this entire macroeconomic setup, I personally cannot call off the idea of an extended crypto market cycle. Now, what does that mean for the economy? Well, it means that we are going to get higher inflation. The only counterbalance that could be an idea out there is the idea that investment into AI could be a deflationary force, making things cheaper, and that such will have an impact on prices of goods and services in the US within the next 1 to 3 years, which I don't think is going to actually happen in that short of a time frame. So the overall takeaway here is very simple. If you do not own assets, you will get absolutely crushed in this environment over the next 5 years. The price of life will continue to rise, assets will continue to rise, and wages will very likely not keep up. Now, while this will be absolutely catastrophic for the average person, this will likely be an opportunity to get ahead for anyone in a position to put on risk. Now, none of this is financial advice, and do your own research. But the truth is that we're stuck between a rock and a hard place as people, where we know that risk is really high in all of these markets. But at the same time, if you do not participate, you will continuously get left behind. The rich will get exponentially richer than everyone else. And if you don't have assets, you will own nothing. If you enjoyed this in any way, or if you got anything from this, be sure to like and subscribe. This is Keith D, and this has been yet another update. Stay tuned for the next thing. And if you haven't already, be sure to click the link in the description to subscribe to Memes and Markets, where we have discussions like this and much more in a long form format and live every Tuesday and Thursday at 12 p.m. Eastern. It's Keith D, and I'll see you next time. Peace.